Okay, welcome everyone. We'll start our second lesson. My name is Anjum Satha and my email address anjum@ukversity.co.uk. Please, if you have any question, just drop me email on my email address. In today's lesson, we'll go through our LO2, which is learning outcome to be able to evaluate the financial performance of health and social care organizations. So today's lesson will be focused on financial performance. So what is meant by performance, please? Anyone? Financial performance. So what's come in your mind? Performance. So what make performance? If you want to measure the performance, we look the financial here, but performance equal to always you measure the performance time in term of the time somebody taking less time, in term of the cost, and in term of quality. So here in this we can look around because the time itself is a cost, and and the quality really is very difficult to be assessed in a financial. So we need non-financial information in terms of the customer satisfaction, so measure the performance. So that will be focused in our discussion. Okay, before starting today's lesson, we'll first recap what we learned during our previous lesson. So last lesson was lesson 1, be able to apply the tools and technique cost accounting. We learn about different cost accounting techniques. We learn about marginal cost, which is meant by all the variable costs. We learn about absorption cost, which is mean the full cost. We learn about activity based costing, which is mean ABC costing. We learn about contract costing. We learn about job costing, and then we prepare the reports for, and we discuss about most of the companies in a health and social care organization, they're using ABC costing. We went through and we checked in terms of NHS, the costing policies. We explore how they allocate the cost, WHO, what they recommend. So today's lesson is the lesson 2, and in lesson 2 we have a learning outcome to be able to evaluate the financial performance, and we have 3 assessment criteria which we'll try to learn and we'll try to use them. So critical analysis, so the word analysis is there, the evaluate the financial statement using the ratios and performance, propose the managerial decision we can make based on the financial ratio. So these are the 3 assessment criteria. So 3 command verb: analysis, evaluate, and propose. So which we'll go through today's lesson. So what is meant by, before moving forward, what is meant by analysis? Separate information, critical analysis. We have separate information into component and identify the characteristics, discuss the advantages and disadvantages of if you're using the data from the financial statement. If you're just looking, not so this is advantage as well. Easy is the financial information, but disadvantage can be sometimes financial information, like you maybe heard about Tesco in UK. Their profit used to be, they earn the profit and the sale was 180 million, but they showed in the book of account 220 millions. So 40 million more, the manipulated the profit. So that's not really telling the true story. So what we need to, this is the advantage, easy, we can look around the numbers, easy to make, but some numbers, this is the companies, some fiddle with the figures, or they use the word creative accounting. They just, under and overestimate the things which is called the creative accounting. So we need to think about those. Are they change the timing, so they should be included this year, but they're not including those figures in this year, they are moving to the next year. So that's the, we can look around those pros and cons. Evaluate, make the qualitative and qualitative judgment, taking into account our different factors. So when we measure the performance, we look pest analysis as well. We do pest analysis, political, economic, social, and technological. We can look around the customer satisfactions. we can look around the surveys, we can look around our brand image. So that's we evaluate, in different qualitative perspective, customer happy, are not happy with our services. So propose, then we can propose based on our analysis to be, say, different stakeholders. Either they can give loans to the company, lend money or not. Then we can look around the supplier provide credit to the companies or not. Invest in these companies or not. So various stakeholders can make various decisions based on analysis. So that will be focused. So that's the our inductive content, as which I mentioned you in the unit contents as well. So please know it's good to be reflect yourself and rate yourself where you are up to now in terms of your current knowledge about financial statement and financial ratio. So anybody knows financial statement? How many types of statement we prepare in accounts? Think about. So four types of statement. Those are compulsory for companies they prepare. So statement of comprehensive income, which is also known as income statement, and also called P&L, which is profit or loss account, and it shows income and expenses of business. So if you want to be look around the income and expenses of the business, you have to look around the statement, which is called statement of comprehensive income. Okay, second statement, we need a knowledge about statement of financial position, which is quite crucial to look around, is also known as balance sheet. It shows in this statement we can find assets, how much worth of the company's asset like building, plant, machineries, receivable, prepaid, and the cash itself. Then liabilities, we can say how much worth of the liability company owes the money, and then capital, how much of the capital the company has. So this is all about shows in the statement is financial position. The next statement we call the statement of cash flow. Statement of cash flow are also known as cash flow statement. Cash flow statement. So it shows three activities, normally is called operating activities. So how much money in and out from the business. Operating activity meant by normal business, your core business. Then we have investing. If you have a spare cash, you can invest in different businesses, and that will be your investing activities. So we can look around how much money in and out from the business, cash in and out from business. You can see under the investing activities as well. Then the last not least is called financing activities. So financing activity mean you borrow more money. If you borrow more money, your cash position will be good. So if you paid off that can be positive or negative cash flow. So we do overall, is it what's happened? Operating, maybe you have a positive, investing, you have a negative, financing, you have a negative. So overall, you have a positive or negative cash flow. Plus we add the opening balance at the start of the year, and it will become closing balance end of the year. So thus we can find, which we can look around in the financial statement as well. So we need to test the knowledge. How many types of statement? Four types of statements. So last left, and I've mentioned you. So statement of change in equity. Equity mean the capital, share capital is also known as shareholder statement, which shows shareholder normally use. It shows dividend, how much dividend we paid. It shows how many shares we issued. It shows share premium, share being issued on the nominal face value or more than the face value. And it shows retained profit. Retained profit mean retained profit is mean previous year, or is also known as a retained income. So all shows in the statement of chain equity, which is So these are 4 compulsory statements published by the companies, and that's normally we can find in the company house or normally on their website as well. Okay, we'll go through now. Critically analyze the financial statement. I mentioned you how many types of the objective of the financial statement under IASB, International Accounting Standard Board. This is the regulator. IASB stands for International Accounting Standard Board, which set the standard, and financial statement prepared under IAS 1, which is called International Accounting Standard 1. What is called International Accounting Standard 1? These companies to provide information about the financial position, financial performance, change in the position of entity. Entity mean organization is the useful wide range of economic decisions. Yes, which is quite for the user. So we discuss 4 types of financial statement we prepare in accounts. Okay, then conceptual framework is good to know. The conceptual framework is set out the principal concept under IASB, International Accounting Standard. They gave us the standard, and that's due to why this is provide more harmonized, unified system throughout the world. That's why we have an international. Otherwise, we have a local standard in different part of the world. Every country have a local accounting standard according to the local needs. So we prepare accounts on the basis going concern concept. We need to be look around, which is quite good to be understand. So going concern mean the business will carry on as a normal activity for unseen. So when the people do the audit or details, they normally give the view that this company is a going concern. It means this company will carry on business as a normal at least 12 months. So we can look around accrual basis. Always we record the transaction on a accrual basis. Like if you have a credit sale, so credits you're not receiving that's your sale, and then you have a receivable 100, so that's your is called accrual basis. So you should record income and expense in that year when they happen, is also known as a matching concept. Then when we look the financial statements, they provide the financial information. So in a financial information, this should be the qualitative characteristic of financial statement. So in the financial statement, the information should be relevant. It should be capable different decision, including materiality means significant. So we not miss the things, those are significant. Like if you're missing the 1 million transaction in your book of account, so you're not telling the true story to your user. So faithful representation, what is meant by faithful? It need a complete information. It need a neutral, not, and it's a free from error, not biased information. So I'm working in and I'm preparing accounts and I'm an investor as well. So there will be a conflict. So enhance further characteristic, comparability. So you need to be give the 2-year statements, so you prepare, so you that give the good comparability of financial statement. Timeline, yes, you should publish the information on public domain within maximum 90 days. Verifiability, whatever you're saying you have a stock, it should be you hold it and it's your control. So that is verifiability. We can verify it. Understandability, the number need to be understand. Those people have a knowledge about accounting or this basic business knowledge. So you should be make it in that language, make it in easy to make it under the heading as per IAS says us to guide us. Okay, then this is IS. We discuss about the statement, and always under IS, statement need to be true and fair. Okay, the statement, profit and loss, also known as the income statement, statement of comprehensive, is look like this. So sales revenue, which is mean turnover, sales revenue, and sales itself is the same thing. Then we cost of sale, how much cost me opening inventory plus purchase, less closing, and then you do minus your expense. So sales revenue minus cost of sales equal to gross profit. Discounted, if you receive the discount received, is other income, and minus all other expense, and that give you the profit for the year. Then balance sheet, it shows you the non-current asset, long-term asset. It shows the current asset, the asset which we are their values carry on changing in 12 months. Then long-term liability, the liability we need to settle is more than a year's time. Current liability, the liability is the obligation which we need to settle within 12 months. And capital investment. So that shows in the statement of financial position. We discussed what shows in the statement of financial position all been explained here as well. If you have any question, so please ask me. Anybody any question? Just think about, read please this slide. Okay, well done. So read this please as well. Okay, now we can look around two healthcare companies. Those are making healthcare product in our, we can pick any NHS trust statement as well. So first is called Bupa, which is healthcare company. So you can copy this link please, and I copy even is called last year's slide is Padlet we prepared, where you can find, just click the link and you can find all the resources under one link, huh? So which is quite good. So let's instead of, I'll go from the Padlet, I'll click here, it will take me, stay there. Why not? Okay, due to some reason it's not working. So what I'll do, I'll click here, just copy the link. If not, sorry, I can copy the link of this. That's why I copied, because sometimes the link not properly work. So you can just copy the link. Now it's working. So you will see there, we looking for statement. So Control F, type here statement of compre and save income. You will see there, and that will take us stay there. So we can see the last year, this year, the previous year 2017 and 19, this is given. So it's because the year end is December, so I don't have still access, should be available, but I just found this one. So look around the profit last year, this year, what's happened. Profit from yes, so if you go back to here, you can see their income statement, which is meant by this Sam. Further go back to, yes, so these are their so they have a total revenue is this from different activities, which is went down. Then they have a cost, that direct expenses, they found the profit. So some companies directly can be, because they're not buying and selling things, they're just providing the services. So the profit before tax, they have 502 million. Last year was 620 million. So now if you look the profit after tax, this year 312 million, and the last year was 486 million. So which is went down. You can take the difference and then you can look around the other statement, look around the financial position, asset worth of how much were, liability worth how much were, and the net asset how much were, and how much is the equity is the investment. So net asset always equal to equity. So then you can look around the cash flow, how much is operating activities, the cash is went down compared to last, but is a positive balance. If you look the cash under investing activities, so is a negative, the cash went out from the business, we use the cash. And then financing activities is also is negative. Last year was positive, we borrow more, this year we paid off, so that's why the cash went out 165 million. So, and plus opening balance, so you do operating activity positive, minus negative, minus negative, what net Q will net from all the activity is 100 positive. Last year was 119 opening balance plus you have, and then you, if any change exchange rate, if it's a negative positive effect, so it's a negative effect, and then you have the this year closing balance. So all this shows, and the equity statement shows how much shares we bought, and all this explained in this statement. So that's the way we can look around the statement. We can make, and the same way we can copy this link for GSK, GlaxoSmith clients, which is used to call GlaxoSmith, and the client of different company. When they merge together, it's become GlaxoSmith client. Okay, next now we'll look 2.2, evaluate the financial statement using financial ratio. So here we'll learn about the financial ratio. Financial statement, their own are the limited as use. For example, you were to identify the business made the profit 1 million. What does this tell you? The business, does this suggest you the business is success? It might be not. The previous year they made the profit 50 million. This is close at revival earning 60 million. So it is important user of the financial statement, interpret the financial and draw up the valid conclusions. Yes. So typical involved in the comparison prior years figures, expenses, and the ratio analysis widely for help to be make the decisions. So when interpret the financial statement is important, a certain who's the user of account, what information they need. So you have to ask the question. Shareholder and the potential investor is more stability and the liquidity they are interested. Supplier and the lender, they concerned with the security of their debt, so they look the profit and the main their success potential. Other user financial situation implied, and various other stakeholders can use. What is meant by ratios? Ratios are the simple calculation based on the interaction in the set of the data. For example, changes in the cost of the sale directly linked to the changes in the sales activity. So changes in the sale activity also have the effect upon the wages and the salary receivable. Ratios allow us to see the interactions in the simple, concise format. Ratios are have a limited use of their own. So that's why we need to be look around and make the final valid decision based on these ratios. Okay, anybody any question? Okay, next please. So how many types of ratios we have normally in accounts? So we categorize them into 4 categories. So liquidity ratio is the current asset divided by current liability. So all the formulas are given here. So that information we can find from the statement of financial position, which is known as total current asset figure divided by total current liability figure. So normally ratios need to be 2 to 1. £2 worth of asset, £1 worth of liability, which is a strong liquid position. And if it's a quick ratio, which is most liquid, because inventory sometimes we can't sell quicker, so we can say current asset minus inventory divided by current liability. This is normally benchmark is 1 to 1. Interest, then we have a financial position ratios, long-term ratios. So we can look around the profit from the operation divided by the finance cost. Once and finance cost will mean the interest on the loan we pay. How many times our profit is higher than the finance cost, which is that's normally lender really looking. The gearing ratio, other is if you drive your car in a high gear is a high risk. So if you have a high borrowing, it can be high risk. So gearing ratio is a high mean high risk, so we can look around. Profitability and use of resources, the other 2 ratios. So profitability, profit from operation divided by total equity figures and non-current liabilities. So add them, you can calculate the return on capital employed, return on the total assets, return on equity mean the share capital, gross profit divided by revenue, revenue means sale, or turnover, same thing, time by 100. And then you can follow these formulas and we can calculate. So which We'll go through the main objective of the financial statement, help to the user make economic decision. That's why, and the ratios also interpret the information that we can. All these ratios being explained with the formulas and their purposes. So I'm not going through in detail, but it's good to read, please, and that will help us to make the effective decision. Return on equity, operating profit percentage, net margin, gross profit percentage. We can look around asset turnover, liquidity, current ratios, and the quick ratio. And we can look around the cost of sales, inventories, trade receivable, and revenues. Yes, gearing ratio, interest cover ratios, all. So now we'll go through our two companies. We'll prepare their ratios, and let's the first. So we've been given two companies. One is called Anika, other is the Paprika. So this handout will be available through Padlet. So if you go here, click here, we're looking the question bank, and you can see there, yes, and you can read online there as well. So you will see there the revenue of Anika is 36 million, other was 28 million. What is the gross profit minus cost of sales? So my gross profit is 16.2 million, and this is 14.2 million. So if I'll calculate the ratios now, so my gross profit divided by sales, which is also known as the revenue, so 16,200 divided by 36, and this is a 45%, and that's 52%. So Pamika Papika is a better than Anika, so we can, which is a 7% higher gross profit. Then we look the operating profit. This is 9, this is 11. So again, Papika is a better. Then we calculate the gearing ratio to calculate the debt divided by debt plus equity. So debt is mean the non-current liabilities. So we can look around here in the statement of financial position, which is also known as a balance sheet. You will see their non-current liability they have, and plus equity, which is given total equity figures. So that's so we can go back to, you will see their debt, which is 4,000, debt plus equity total, yes, which is 30155 times by 100, so 13.26, and this is 17. So we said high gearing mean high risk. So this is Papika is a more risky because they have a more debt, and Anika is less risky, which their gearing ratio is less. Then there are two formulas normally we can use, debt to equity or equity to debt. So these are different ratios we can calculate based on, and then we can make the decision. So let's we make the decision. You're an investor, you want to make investment. So this company give you return 11.5. So you're happy to invest in this, but this company is not meant by, they will pay you that same dividend as well. The reason is they have lot of other commitment. They have to pay the loan, which is 71.06%. They owe the money. Only they have their own investment, which is 28.9 92%, 93%, something, so we can look around here. So this is more risky as well. If you're a high risk taker, you can invest in Papika. Higher the risk, higher the reward can be, but you have to quantify, measure the risk. Okay, next we look the now proposed decision of health and social care organization based on. So you can propose decisions now based on the analysis. So a company performance may be compared to its previous period. So we can look around 2 periods, maybe adjust the figures and the price changes we need to keep in mind. All this we need to be make horizontal. We can look around this analysis, try to overcome the problem of vertical and horizontal. So that's different ways to calculate the ratios and different ways to present. Industry average, always look when maybe your ratio is quite good, but you need to be compared with the competitor, with the energy with the industry averages. So industry average, like I mentioned you, the liquidity ratio need to be 2 to 1. So if your ratio is 2 to 1 is good, so you have to be look around So you have to be measure it properly. If otherwise, we maybe will say it's good, but in again the industry average is bad. So it's every industry have, and you have to follow the benchmark of the industry. So please, you just make sure we follow and we look around. Anybody, any question? Okay. Next, we look here, the consider the business strategy. Based on you can find what is the business strategy. The ratios maybe show you particular weakness of the company. Has the business plan to deal with these weaknesses? So you need to be look around what strategy they will draw. Turn the business around, making changes can be take time. Yes, you need to think about what is happening in the industry. Is a declining state, growth state, like in the UK, highly likely the construction industry after this coronavirus things will go up. Yes, so we need to think about those. Or further, you can look around our trade receivable is we have 30 days, trade payable in 60 days, inventory is converted into finished good in 10 days, so we have working capital cycle how much? So 30 plus your 10 minus your 60. So you need to think about there is a cycle of so around 20 days. So we have a 20 days worth of the money so we are holding. This will be the positive impact on the cash flow. Or in future the company want the policy credit control policy to this they want to be increased to 90 days. So we need to be look around the strong credit control strategy being developed and in place. So impact when they calculate the ratios in order to help them make the decision. Investor or the lending businesses should be considered the impact of doing the business ratios for profitability with the poor liquidity may be improved taking in the long-term loan. So we need to be look around. So we discuss in term of so investors help to determine to buy or sell. So different stakeholders, potential investor that can help these ratio buy the shares or invest more money. Lenders whether to loan give the loan, not suppliers whether to give the credit or not, customer whether to deal with the company or not, because if they're giving you sale guarantee and the company will liquidate, so what's the point of the sale guarantee, the product warranties and guarantees? So we need to look around those government agencies and various other stakeholders. So then we discuss in we prepare the ratios of Paprika and Anika. So gross profit is a better of Paprika, operating profit is a better of Paprika, and Anika gearing ratio is better is Anika, less risky Anika, and asset test Anika. So as for the profitability is concerned, is a better in Paprika. Anika is a profit ratio which is was not a good Paprika or perfectly acceptable. The other ratios Anika is better in terms of debt abilities and interest. So while the Paprika interest cover is lower and Nika is marginally acceptable, so we can dangerous level of debt they have in Paprika. So in conclusion, Lever's main concern is the riskiness of the investment. So I would advise to be invest in Nika. Nika is the best company to invest than the Paprika. So on the basis of these are calculation which in did in the previous learning outcome, so we can in assessment criteria, so we can make the decision either to which company you will invest. Okay. Then I pick the company, especially in the health sector side and the healthcare, which is making the product GSK, and we calculate the ratio. So just copy the link, please. GSK, and then you just paste this link there, and you can see their Nika's ratios. So GSK's, like Glasgow and Smith and Klein's ratios here. So we've been given different years. You will see 19, 18, 17, and even last 5 years. If you want to be more, it's been given even 10 years. So what happened? Profitability margin last year, this year dropped. This year dropped. So you'll see there lot of things. Return on capital as a percentage is increase. Yes, as a percentage increase. So if we look the current ratios is 1.3, last one was 1.4, quick ratios 1.08, which is and 1 point, which is quite still is okay. Here we need to look around the industry benchmark now. So interest cover ratio is 1189 times. Yes, so which is quite good, less risky company to invest. So if you look other ratios as well, cash flows, net profit, yes, how much cash coming in again compared to 69.6, which is quite not bad. So whatever the sales 69 we are receiving the cash is quicker inventory turnover ratios, and we can find in days as well. Anybody any question there? So please, you can look around. On the basis of this you can make the decision. So GSK is quite good in terms of the profitability, which is increasing, and overall is a good company to invest. Is a less risky gearing ratios. We can look around interest cover ratios. So I copied the Padlet for you as well, where all the links will be. And if you have any questions, so please drop me email. And today lessons we learn about how many types of financial statement we prepare. Anybody? Four types of financial statement: statement of comprehensive income, statement of financial position, statement of cash flow, and statement of change in equity. Then we learn about four types of ratios we use and we prepare: profitability ratio, liquidity ratios, use of resources, and gearing ratios. Then we discuss, just we don't need to we look around the ratios, we need to look around uh, the strategy of the company, which is the internal environment that come to the internal, that's the company, and we can look around that strategy, how this will help. We can look around industry averages, and we can look around some environmental factors, which is called pests, political, economic, social, and technological factors as well. Maybe it's a good company before the coronavirus, but they were not good in terms of that. So is the issue can be sustainability now. So we can ask the question. So that's we learn to look around the performance, and in a healthcare and the normal as well, in any other business as well, we can make the decision, and we can. So if you're comparing healthcare, so you should look the industry average in the healthcare sector, not other sectors. So always good to be compared with the competitors. So that's all today lesson. So please, if you have any question, drop me email. In the next lesson we'll go through our LO3, and have a nice time, and I hope so I will speak you all. In the meanwhile, if you have a question, drop me email on my email address. Thank you. Bye bye.